all the investors have doubts in their mind. How should we proceed 2026?
Maybe God has given me a gift to put more money to work at a time when markets are probably poised to take off again.
You can create by investing in equities for next at least 10-15 years is enormous. So what's your take on those? Welcome to Wealth Metric podcast series. After COVID, the market was rallying phenomenally. I think last year the returns has been almost flat. So all the investors have doubts in their mind. How should we proceed 2026 or how should we proceed for next 3-4 years considering this kind of volatility and geopolitical situations around the world? So today we have a special guest with us. He has around 30 years of experience in the market and he's been the MD and CEO of Mahindra Manulife AMC to talk more about all those things. Welcome, sir, to the Wealth Metric podcast.
Thank you very much.
Sir, like we just said, many of the investors have their doubt in mind considering the returns which they used to enjoy in the past. Now their portfolios are not performing at par with how it used to be in the past. So there are concerns about last 1 year, the market has been flat, investors are not able to meet their expectations. So how should an investor place their portfolio considering this situation for the next 2-3 years?
Yeah, it's an interesting question. So I would say a few things. One is that a period of 12 months where the return has been flat or a period of 12 months where the return has been negative is not new. It is, you must understand, part and parcel of investing in equity. If equity investing was always to be a straight line, then the returns would have been very different, right? If you think about straight line expectations, then fixed deposits give you that straight line expectation. They would not disappoint. They would not give you a 0% return. But equity is a product where, frankly, the magic unfolds in 5 years, 7 years, 10 years. And in that journey of 5 and 7 years, there will always be periods of 12 to 18 months that you will find markets not necessarily behaving the way you expected it to. And sometimes I would put it that they end up being a bigger opportunity to invest more money, because when somebody has taken a pause in a journey, but you know that the journey is going to continue and it will actually reach the destination at some point, this is not the time for people to worry or be perplexed, but instead for people to say, maybe God has given me a gift to put more money to work at a time when markets are probably poised to take off again.
Yes, I also feel that when we interact with people, they understand it when it comes to real estate. They understand it more when it comes to gold. So people very well are aware that that's the right time to purchase a gold when the prices are coming down. It's the right time to purchase your house when the property prices are coming down. But when it comes to an equity or equity investing, people sometimes not understanding the same fact. So it's the right time to add more or right time to invest more when it comes down. Rather they feel more worried, more feel they're fragile to invest more. So what do you think will be the reason because they understand the same thing when it comes to real estate, when it comes to gold, but they do the vice versa when it comes to equity investing. So what would be the reason for that?
So I would say there are two reasons. The first reason is fear, because that's ultimately, listen, we are all human beings. We are not going to necessarily react to what we see as notional losses and not feel a bit of fear as to can it become worse. So there's a very natural element of fear. Now the question is, why does that fear not play out when it comes to investments that you have done in the past in gold, where gold has also not done anything for sometimes periods as long as 5 years, or real estate, where sometimes you buy a property and you realize after 3 years the value is actually lower, not higher. The second emotion, or shall I say feeling, that causes them not to worry is experience. People in markets, especially you look at a market like Kerala, they have a large degree of comfort and experience having invested in gold and real estate. So that experience has given them the comfort and the confidence to wait it out, because they have had enough experiences to show that if you wait it out, you have patience, it will pay out. I would say equity investing requires probably the same degree of patience, perhaps more, because if you look at any back history, equity actually pays even more to the person who has patience and gives time than perhaps even real estate or gold. But because it's relatively a newer asset class that investors are looking at least when I mean that, it's not to say that investors did not invest in equity before. But now it has become a mainstream part, especially equity funds, especially SIPs. So I think as time goes by, as experience comes in, people will have the confidence. I mean, I can give you a very recent example, right? Think about October 2024, not just more than 12 months before. In October 24, if you realize, when the markets fell, after a long time they fell, first reaction of investors was to invest more, because people said, "Arey, this is a magical chance for me to put money." Then November it fell again, December it fell again. By January, most investors were now saying, "Oh, this is now a very, very bad thing. I'm not going to invest more. I will look to redeem, because I have made profits over the last 4-5 years." By the time we hit March, where people were still wondering what to do next, April onwards, we have seen a bounce back in markets, right? And my message to investors would be, this is a story that unfolded in 6 months. You go back 20, 30 years or 40-year history of equity markets in India, there are times when this story has not played out over 6 months, it has played out over 18 months, 24 months. Contrast it to COVID time, the story played out over only 1.5 months. So you have to remember that this is a part and parcel. I would be worried and fearful if this is the first time it is happening. But I would say this is the nth time it is happening, and that is the beauty of markets. There is an old Hindi saying actually, कुछ पाने के लिए कुछ खोना पड़ता है, right? So you want healthy growth in market over the long term, you have to be able to take the volatility in your stride, and with experience you will be able to use the volatility to your advantage and probably invest more. That's what I would say is probably the big difference. Fear is equal, but in case of gold and real estate, there is the experience and the comfort that in the past this has happened and it has been sorted out. With equity, as years pass, people will also get that experience and that confidence to stay put.
Yeah, correct. I also feel the same thing because of the people who have experienced in gold, like the mothers, sisters have invested in gold for 20 years, 30 years, and now they are enjoying the benefits of it. So that's easy for them to understand it, how it behaves. So the same kind of experience is what we lacking in terms of equity. So there are not many investors who have already experienced it for 20 years, at least 15 years, or not even 10 years. Because we always see that as per the data analytics, the surge in equity market has actually happened post-COVID. So the most number of people have experienced only for 5-6 years. And again, out of these short-term investors, most of them are experienced in and predominant returns, or the predominant part of the returns is coming from small and mid caps. So again, now people are always talking about why can't we invest in that small cap is giving 20+% of return. So why are you projecting 12, 13, 14%? So then how do you see that market segmentation? Where is the opportunity for the next 4-5 years? Right? It's again the large cap or in the mid and small cap space?
You have asked multiple questions as well, hidden questions. So you'll just have to give me some time. So fundamentally, why do we say think about your return expectation being 12 to 13%? Just very simply put, equity market returns are a function of a very simple thing. It is a portfolio of equity stocks whose stock price will go up. That stock price will go up based on two parameters. The profits of the company will be reflected in the EPS, and the market will assign a price earning multiple to that EPS. Over time, profits will grow, and over time, sometimes P is also re-rate upwards, right? That is the story about a company and a company stock. Why does a company exist? A company exists not in isolation. Company exists within an economy, within a country. So the starting point, if I am setting up a company and I want to create profits, I have to be conscious of the environment in which I am operating. So you take a step back and look at the Indian economy. Do we have the confidence that the Indian economy at this current juncture is likely to grow by 7% or 7.5% consistently for the next 5 to 10 years? The answer is probably a lot of confidence that that will happen. Beyond that, typically what you describe as nominal GDP, because that what I'm discussing is only the real actual number, but everything becomes expensive by the day, right? As individuals, we always encounter that. So there is an element called inflation. In India, it has historically been 7-8%, but obviously in the last few years, the average is more like 4-5%. So which means the economy is going to grow in nominal terms by 12%. If I'm a company, I will say I'm not a large element like economy, I'm a smaller element, I'm more nimble. Perhaps I'll be able to deliver a profits or growth which is maybe 1 or 2 percentage points more than the economy. So that is 13 to 14%. So just very simply put, if a company grows its profits every year by 13-14%, and it's not going to be one single line. 1 year it may be 20, 1 year it may be 5, 1 year it may be -6, but on average you will grow at 13-14%. Eventually that will get reflected in the stock price, because the stock price is nothing but a function of price earning multiple into the EPS reflected in the profits. So that is what the return expectation should be anchored on, frankly, and that's why we tell people. The fact that the last 5 years has delivered probably 15-16%, I would say is an aberration, because historically returns in equity have always reflected in some sense corporate earning growth. But perhaps you therefore have to understand and be more comfortable that the last 1 year has therefore been nothing but a time correction, which is bringing those returns closer to what normally their return expectation should have been. Coming to your second part, okay, if that is the case, 13-14% is an expectation. I always believe when somebody invests, you must keep a margin of safety. It's like giving you an example. I am needing to catch a flight. Flight is at 8 o'clock in the morning. Reporting time is, let's say, 6:30. Nobody leaves their house at least knowingly that I will reach airport at 6:45 or dot at 6:30. You'll always keep a 10-15 minute buffer. So which is why when we say return expectation, when we believe that corporate earning growth theoretically can be 13-14%, that 10-15 minute buffer is the expectation of 12%. That's the way I would look at it, and that's the way I would explain it. Coming to large, small and mid, I think it's an unnecessary debate in my mind. People, I often say this, successful investing in equity is about the lower the IQ you have, the better it is. The higher the EQ you have, the better it is. In the sense, this is not a game of intelligence. It's actually a game of common sense. Now, if I apply common sense, you look at it from a very macro lens, a 30,000 feet view. India is today a $3.5-4 trillion economy at a 7.5% GDP growth, nominal 11-12%, likely to be a $7.5 trillion economy in the next 5 years. That economy will grow on the basis of rural, it will grow on the basis of technology, it will grow on the basis of services, it will grow on the basis of manufacturing. Where and what will happen, which company will rise to take advantage, which company will not, I don't think will be judged by that only small companies will win or large companies will win or mid companies will lose. So I think that is a myth that one should invest only in small caps or mid caps. The best thing to do if you want to participate in a growth story is put your eggs in multiple baskets, which means buy a diversified set of funds, whether it be flexi cap or multi cap. Automatically you are getting exposure to all the possible caps. I'm also fond of saying that, well, you didn't ask the question, don't obsess about which sectors are likely to do well and which sectors are not. According to me, in every sector there will be winners, in every sector there will be losers. Job of a fund manager is to hopefully identify more winners and less losers. Anybody who sets up in the morning as a fund manager thinking I will only buy winners is fooling themselves. That's not possible. But at the same time, there's enough opportunity in the market. So have a diversified portfolio, multi-sector, multi-cap. That is the best way to operate your portfolio such that you achieve that 12-13% desired return on a 5 to 10 year time frame. Sorry, long answer, but I just thought I want to give that context.
Yeah,
I understood the concept you just put forward. No? The
Yes.
lower the IQ, you make more money. Higher the EQ, you make
Yeah,
more
I mean,
money.
I'm not trying to dumb it down by saying that no, only low IQ people. I'm just saying that this is not a game of intelligence. This is a game of common sense and emotional control. There's enough of work done in the area of behavioral finance that shows that, see, ultimately the most, if somebody asked me in my 30 years of investing career, what is the one magic pill? If you're given multiple pills, pill number one is IQ, pill number two is whatever. What is the magic pill that is ensured maximum wealth creation? My answer is it is the pill where the word written on the pill is time. If you give time to your investments, there is no way on earth you will not eventually result in very good fruits. But if you give intelligence, if you give concentration, if you fall victim to flavor of the moment, those are pills which may give you some short-term excitement, but not long-term wealth.
I'm also reminded that Morgan Housel, in his famous book Psychology of Money, he's mentioned the exact thing. Your intelligence is not as important. Your behavior with money matters a lot in the end.
Absolutely. And I must say, and this is of course a personal thing, I'm not trying to profess this as some investment thought. You must also give some element of credit to luck. That is also an element. Let's not pretend that this is only about skill, it's about luck. Because I can give you an example. In my past, I remember there are times when I perhaps, if I had not had another meeting and I was late, I may have actually sold something. But something came up, I didn't. I was lucky. I was not smart, right? If I was sitting in office, I may have sold. But something came up, I didn't. Next day, I went to Cochin for a meeting or somewhere else and it just didn't happen. 3 months later, I thank my lucky stars. Thank God I had another meeting, right? So it's a combination of luck and skill.
Since you mentioned that time is the magical pill, I often tell people also, even the simple formula of compound interest, you have 1 plus R raised to T. So the additional year you spend, keep investing, it has a raised to impact.
Yes.
Rather than focusing on the time which is in our hand, people often waste their time by focusing on the R for generating extra return. They're actually losing in terms of time, which has a raise to impact. Yeah. So that's what I often feel that. Yeah. So now coming to, since you mentioned about it's better to leave to a fund manager. Again, another debate the investors used to put forward, even for it's a debate, even for their managing their own money. I often hear that, so direct equity, direct investing is better. So why to investing in a mutual fund? And direct investing, we will be able to generate extra returns. So why there is a management fee involved, there is a broker commission is involved. So what should be your message for those who are trying to invest their own, but may not have the time and expertise as a fund manager doing it professionally?
So again, we go back to time, right? I can tell you personally, I should theoretically have the ego or the arrogance to believe that since I manage money for a living, why on earth am I buying a mutual fund? I should buy stocks myself, right? The reality is that in order to, I'll give you a contrast example, right? Just think about this as a plant. Ultimately, you can buy and plant the best seeds, but if you don't have the time to water it every day, it's not going to work, right? So most of us are either salaried people or we are running businesses. If you say that investing in equity is something I want to do myself, first point I'll put, it is surely coming at the cost of something, because the last time I checked, there was only 24 hours in a day. So the question is, do you suddenly believe that you will make more money from investing directly in equity than you would from the business you are running, or perhaps from the job you are doing? Because if you do well, then hopefully you will advance your career, etc. The second is, when we discuss cost and fees, what are we discussing? 1.5% more often than not is the TER, 2% at max in most cases. It's when you're discussing about creating 12%, 13% compounded return, that 12, 13% that most funds have given on average is after the expense ratio anyways. right? The final point is we must compare apples to apples. What happens, and it's very humanly possible, even I will still do it at times. We compare an equity fund return with our best performing or our 2 or 3 best performing stocks, not our portfolio of stocks. If we actually had the time and energy to make the NAV of the portfolio of stocks, trust me, many people will be in for a very rude shock, saying, my God, what have I missed out, right? Just look at some of the funds. Still, many people give examples. Had you bought XYZ company in 1996, it has gone up to 100 times. Had you bought this company in 1998, it has gone up 40 times. My point is, if you see many equity funds you would have bought in that same period, that has also gone up 100 times, 150 times, because people are not able to, and it doesn't come naturally. Even in school, we aren't taught that, right? We think good things are number of times. Percentage is not seen as a great exciting thing, right? If I tell you that I invested in this and it gave me 18% compounded return over last 20 years, you'll say, oh, looks like a very good result. I tell you that I bought this property and it has gone up 50 times in the last 30 years. You'll say, boss, you are so lucky, you are amazing. Actually, the CAGR of the property is lesser than the CAGR of 18%. But because number of times is the way magic is supposed to be seen, we look at that. So my simple philosophy is that if there are people who are willing to do this for a nominal fee, who are not smarter than you, it's just that they are giving it the right amount of time and experience. They are not doing it on their own. Just remember, in my own firm, we have a bunch of 12 different people. They have all experienced in the markets. So I have the benefit of asking my colleague next door, oh, I think because of this consumer companies look very good. What do you think? And that person may come up with a slightly different perspective and I'm be, okay, maybe I should rethink. All of that kind of teamwork, that collective knowledge, will always be better than the power of one person. And so because of that, I personally took a call many years ago that I am not walking the talk or practicing what I preach by buying funds because it is walking the talk. I am doing it because it's the much smarter thing to do.
Yeah, as you rightly point out, no? Human brains always have a tendency to skew towards the absolute value, because in your real estate, in your land, in your houses,
yes,
you always put forward in terms of absolute value. I bought a property at 50 lakh or 1 crore. Now it gives me around 2 crore, 3 crore. So the brain has a skew towards this absolute value. But in mutual fund, we always talk about return, 12% CAGR, 14%, 15%. So comparing these two things, it's always absolute value that gets the attention much more than the percentage of returns.
Yeah, and let me remind viewers that let us not only focus the discussion on 12%. Ultimately, a successful portfolio needs different elements. So there should be multi-asset, there should be an element of fixed income, etc. It's not as if 7% is bad and 12% only is good. At the end of the day, life is uncertain. Life has different demands of yours. You will need a portfolio which is diversified and a portfolio with products that are typically designed to give 6 or 7%, complemented by products which require time, which will deliver 12%. That's the ideal portfolio. It's not a one-trick pony. I just don't want to give people the impression that the only thing better than sliced bread is an equity fund.
Since you mentioned about diversified portfolio, financial planners often talk about the right asset allocation. So you need to have a proper asset allocation. Based on that, you should allocate your portfolio. But even then, people are more skewed towards the real estate portion. So when we have conducted a study, almost 85% of their asset or net worth are being distributed towards the real estate. So remaining 15%, they have all other assets coming. So it's not the return part which is worrying me more. It's about the liquidity part. So after a certain age, your liquidity has to be far higher. So what do you think about those kinds of asset allocation?
See, in some ways, I respect it because it has contributed to many families' well-being. But just because something has worked and it was good in the past, you can't ignore some of the elements that come in the way of it working for the family's future. And see, liquidity is an issue at one level, but I would say that it will increasingly become an issue of managing succession correctly, right? Because at the end of the day, you cannot break a house or a property into 4 parts and 5 parts if you want it, but you can break up an investment portfolio into 4 or 5 parts, right? So as long as, see, if you think about 20, 30 years ago, there was a period where land in most parts of India exponentially grew. That happens when a country is developing. It happens, post 1991, lots of magic can happen. Now we have become a lot more mature, which means my expectation from real estate probably will be very similar to equity in terms of returns. In which case, the fact that one asset class is very illiquid, but more importantly, much less divisible, should lead me to look at it. You also realize that there are now products, including within mutual fund space, that buy real estate investment trusts. So you are not as if you are running away from real estate. You can buy products which have got some exposure to REITs, etc. I think for a variety of reasons, you need to think of it, the most important being succession. It's not easy. Also, reality, I don't know how many of your viewers face this. Many of our younger generation go abroad. It's not easy to have the same ownership of property when you are an overseas citizen, right? So then there's an added complication that you suddenly have been given an asset in succession where you are an NRI or an overseas citizen. Then you end up having to sell it at a distressed price because your ownership has its own challenges, etc. So I actually find a lot of families looking at equity or other liquid assets simply because also their next generation has chosen to follow different paths. And you're aligning your portfolios to that as well, because ultimately, what are you building this wealth for? You cannot be having an objective of building wealth just to say, because I want to be rich. You have to build wealth because you want to enjoy life. You want to enjoy life because you need to be happy. That's the most fundamental want of a person. And if there is anything left over, you want to help your next generation have a good life. And in that context, asset allocation would demand a serious think about liquidity and the ability to succeed or use succession well.
So, like you mentioned earlier, the emotions play a major part of it. So, I often felt that since real estate or a land or a real estate assets is a tangible asset, people often, their ego comes into play. They can tell people, that property belongs to me. This is the property we acquired. So there they get a lot of satisfaction, a lot of enjoyment, rather than the kind of looking into more returns aspect of it. So how do you see that the coming, its wealth is not only for building it, as you rightly mentioned, it is for enjoyment also. But the one side, people may not be able to enjoy it, but they find a pride in owning that property, those kind of assets.
So like I said, I'm not trying to prescribe to people that you shouldn't own land or you shouldn't own real estate. But also think about, I think the aspiration of a person today is also evolved, right? There used to be a time where perception of somebody's success or happiness was tied to tangible things. But you read so often, the younger generation, for example, also says, what I want in my life is to enjoy experiences. I don't necessarily only want to enjoy tangible things, right? So at the end of the day, when you own a portfolio of mutual funds, it is tangible. It is a statement of account which reflects that this is the amount of investment you have. It is not some intangible amount we are discussing. And I think that's changing. I do find sometimes quite humorously, I walk into some dinner conversations and people are discussing the last fund they bought or the last stock they bought. People are no longer only discussing the last property they bought. And you know what is the beauty? In a very funny way, I'll say, the advantage is that you don't buy property every month. No, so you can't go to the dinner, family dinner, every 2-3 months and discuss the same property. Somebody will say, I know, boss, you bought this property 10 years ago. Every Christmas you cannot discuss the same property. But you can say, I bought this last year. There can be a different fund you want to talk about this year. And I go back to, I mean, this may sound very philosophical, but life is not only about money and status and what you own. Life is about happiness, life is about enjoyment, life is about experiences. And to my mind, you can't take your land with you. You can't take your mutual fund portfolio with you when you go to your next place. But at least what you will take is a sense of having lived life. And that's where I would say liquid forms of investment play a far, far bigger role. Like I said, it should not ever be treated as this versus that. It's a point of things have changed, times are changing. Maybe it's time to make a subtle shift. If you are having 80% of your net worth in real estate, ask yourself for your next generation or for your current needs over the next 20, 30 years, what is the harm of 80 becoming 50? Nobody is saying 80 should become 0. But maybe 80 can become 40 and the remaining 40 can be made in more liquid instruments, various types of funds, etc. Whatever you think makes sense for you or your advisor makes sense for you. That's the way I would approach it. Anything in excess is never good. That's a very simple rule.
At Wealth Metrics also, our tagline is prosper with purpose. So
Yeah.
we always advocating investing based on your purpose. So what is the purpose of your investment? What is the purpose of your life? So our objective is to align or help them in order to achieve what they want to achieve in their life.
Yeah.
Since you rightly mentioned about investing in experiences or enjoying the life and the happiness. So I just want to ask you what financial freedom means to you.
Financial freedom, that's a very deep question. I would believe that, I honestly don't know when I achieved financial freedom, to be honest with you, because I don't think it's a number. I think it's a state of mind.
About the number.
No, I know, but I'm just saying when I think about that question, I don't think it's, even if it really normally means, tangibly, it's a number. After this number, I know I have provided for everything I will ever need. That's normally a number. But at some level, when you say, what does it mean to you, it then becomes a state of mind, right? And that state of mind, like I said, is to then be able to live life on your own terms. If you're able to live life on your own terms, do what genuinely makes you happy, I would believe do a little bit to contribute to society. That is what financial freedom allows you to do. Different people will meet it at a different point in time, and like I said, at some times it is important to say what does financial freedom mean to you in the mind, not on a piece of paper, because otherwise, we are as human beings very guilty of changing the goalpost. Somebody will say that if I get this much amount of wealth, I will be financially free, then I will do this, I will go here, I will do that. You find so many of those people 5 years later, they are actually 2 times that amount of money, but they will describe, but life has got so expensive, this has happened, my child is going to US to study, etc., etc. That will always happen, right? But you have to live life for yourself first. And to me, financial freedom is the ability for you to live life on your own terms, therefore making sure that when you're living on your own terms, you'll obviously take care of friends, family, and all of that. And I would genuinely believe at some level, being able to contribute to society at large, that's what it means.
Yeah, exactly. Nowadays, there are a lot of people wants to fire movement also. Yeah. So financial independence and retire early. So there are many taglines or attachments comes along with the financial freedom. So have you ever thought about your retirement, or have you planned for? I'm sure that you already planned for it. So can you get a little bit of?
I have honestly not, because I think God has been kind. So I think at some level, because I've been in this business for so many years, and some of this comes naturally. I think at some level I realized at some point, I don't really recollect the imagined point in which I said it's not a number or a date, right? I just know that should I wish to retire, I could retire tomorrow morning. I just know that, and it's probably been true for many years now. So I'm able to do the work I do because I genuinely love it, right? That's the way I think about it. I am not a huge proponent of acronyms in general, FIRE and so on and so forth. Ultimately, every individual, their life story is different. no point working and putting yourself under pressure because you put a date to something. You will then become unnecessarily unhappy. So what if you don't retire at 45? Like, I'm just putting it this way. If I am able to enjoy the work I do, I'm able to enjoy the other things outside of work that I want to do. What has retirement got to do with it? It has nothing, because as long as I'm happy, it's fine. So you shouldn't retire because it's fashionable to be part of the fire brigade. Trust me, in many cases, you'll get very bored sitting and doing nothing. All I would say is reach fire in your mind, not fire on the paper. When you reach fire in your mind, then your ability to continue to work on your terms, genuinely feel happy about what you want to do. If for whatever reason the job you are doing is not giving you satisfaction, because you have reached that situation, you are able to change and find something else. You don't have the risk of something going wrong. Those are the things that it would matter. I'm maybe old school in that respect, but I don't think somebody's objective should be about how quickly they can not work.
I think that's also one factor which is adding to it, like you mentioned. If somebody is able to enjoy the work they are doing, there is no point in calling for retirement. But it's very, very few people is able to achieve that or able to do so. So most number of people now, they will be working on the areas where they are not enjoying. So maybe the corporate rat race scenario or the work pressure is getting a toll on them. So those kind of cases, for them achieving the fire at the earlier stage, then they will be back on work where the areas they will be able to passionate about. So that time money need not be the driving factor, because they are able to achieve a financial freedom or a fire, at least in papers. Then they will be able to work on the areas where they used to enjoy.
Yes.
Like you mentioned, they are enjoying that. So that need not be the income earning areas. There can be income earning areas also. So
yes. No, but see, I'll tell you, the difference is that, why do people struggle is because, see, the percentage of people who are able to, for example, reach this desired goal and not need anything, because they have, for whatever reason, run a really successful business, or they have achieved a lot of success in a career, corporate career, and made a lot of salary, money, etc. That percentage is probably 1% of the population, firstly. So everybody else, the reality is that if you want to reach these kind of goals that FIRE describes, which is the ability to retire earlier than normal and so on and so forth, typically the trick comes from, therefore, learning to invest very early on in life. It is not, for a lot of people, majority of people who are running a day-to-day business or they are doing a day-to-day job, it's very unlikely that you're going to be able to reach those situations just on account of the job or your business. It is going to happen only if you've invested correctly. And to my mind, investing correctly in the context of FIRE and even broadly is, the earlier you start, the earlier you're going to be able to retire. And I would say to the Gen Z or the young people who are listening to this conversation, that's the biggest lesson I learned. I'm being very honest, I didn't follow it. It's not that I did not have money in the bank account that I could have invested. I did not pay attention to it. Had I honestly started to invest as early on in my life as I could have, based on the bank balance that I had, I would have reached that perceived FIRE scenario a lot earlier, I think, than I even did. So that would be one clear message. The reason, don't think about the outcome. I need the outcome to be FIRE, I need the outcome to be this. Think about the process. Right? One of my favorite cricketers, Mr. Dhoni, keeps saying, right? You must have a plan, trust the process. If you trust the process, you have a plan, it will happen. Whatever has to happen will happen.
Success or failure is the end result. You
Exactly,
need to trust the
exactly.
process. Yes. So since you already mentioned you have already achieved financial freedom, or if you want to retire, you can retire at any point in time. So can we have a little insight on how's your asset allocation, how you have planned for?
Yeah, but I will still clarify, lest I get multiple calls saying, oh, you're such a, I didn't realize you're so rich. It's not. It's like I said, it's in the mind. It's in the mind about how much you believe is enough for you to enjoy a life that makes you happy.
Yeah,
Right?
depending on each and every person, how
yeah.
they want to live.
So my allocations today are probably, I would say, about maybe 60% in equity, uh, another 30% in, or maybe 25% in very liquid short-term debt, because at some point I may want to look at some more equity, and the balance 15% in international equity. Yeah, because I am a big believer, if you can manage it with the right advice, I think diversification is a very, very good tool. And sometimes diversifying into opportunities outside India is also quite lucrative, quite sensible, but it's not for everybody. So I'm just clarifying that.
Yeah, but what shocked me that the percentage of gold and the percentage of real estate.
So actually, sorry, I probably have like a percent in gold, but when I do have a couple of multi-asset funds, right? So when you buy a multi-asset fund, it's
You get a
automatically,
fraction, yeah.
indirectly, there
You
is a
get in your
gold.
fractions.
No, there's no real estate. I don't, I mean, I live in a home in Mumbai. I have a place in Goa. I don't count it as investments. I count it as places. They're home. So I don't add that up. I don't have any other real estate
Yeah,
investments.
ideally, you should not count your own residence as part of your net worth.
Yeah,
Asset
and
allocation, yes.
I, like I said before, I think it's not like I haven't bought real estate, both land as well as property in the past and not benefited. I have, but I'm just clear that the real estate business or market has matured, and now you will get risk asset related type returns. I believe you should mostly invest in what you understand. I genuinely understand equities a lot more than real estate, so I'm more comfortable parking my risk assets in real estate, which is why no real estate. Conversely, I have something which I would say is rather unusual. To have 15% in international assets is unusual, right? But it is something that I'm comfortable because I like to read, I like to understand markets outside India. It's part of my job as well. So as a consequence, I've invested overseas.
And nowadays, there is a lot of international mutual funds also are running international funds. So it's
Yeah, but
relatively easier.
consequence to my job many years ago in Morgan Stanley, my first investment in international equities happened in a sense by accident in like 2012. So that's like 13 years ago.
13 years.
So that was long before feeder funds came. But again, because we are at Mahindra, Manulife, particularly Manulife is a global company, you get the opportunity to talk to various portfolio managers across the world. You get to hear about markets and opportunities. And some of them sound pretty decent. So like I said, it's a diversification tool. It's not for everybody.
So before ending the talk, so we just want to mention about how the future look like. So that again, there are a lot of talk about India's future. India is going to be the bright spot for the next at least 10, 15 years. So the kind of wealth you will be, you can create by investing in equities for next at least 10, 15 years is enormous. So what's your take on those?
So I broadly agree, but I'll just give you a slightly nuanced answer. Our Prime Minister Modi ji has been framing this, I think, brilliantly in terms of our goal should be Viksit Bharat by 2047, right? If you go back in history, and this is not so much economics 101 or finance 101 or investments 101, but just purely socio-economic history, or call it whatever. There's a lot of literature and writings on the fact that a nation's citizens have tended to enjoy maximum prosperity across a complete history of that nation, pretty much ironically at the same period. And that period ends up being a period when that country has moved from being a developed country to a developing country to a developed country. Okay, so it's the prosperity creation of that magnitude didn't happen when that country was developing. It didn't happen to that magnitude after it developed, but it happened in that exact period of developing to developed. I believe fundamentally India is in that journey of moving from being a developed country to a developing country to a developed country. Now, whether that happens in 2047, 2040, 2052, I don't know. What I'm genuinely excited about is this is the period of potentially maximum prosperity for all of us. Therefore, the old English saying, don't look a gift horse in the mouth. And therefore, you should be very, very confident, and that's why I believe EQ has a big role to play. Right? If you have the confidence that we are going to be moving from developing to developed, not asking for a tick mark that we are now developed. Just look at this history, how it has played out in Singapore, in South Korea, in Japan. Just giving you examples of a few countries closer to home. You can go to Norway, Iceland, etc. You just look at those periods when that country used to be called developing, it is now called developed. Look at the per capita incomes, look at the wealth creation. It's just phenomenal. Never happened in those countries before or after. This is that time for us, in my view. And I would believe everybody should be looking at this. If this does not give you enough confidence to invest, I'm not sure what will.
So so it's a nice tone to end the talk. I'm again reminded of once Warren Buffett has been asked, what do you consider as your biggest luck? So he replied that being born in US and being able to live through in the golden era of US. So that he considers as his biggest luck. So I also feel that we all are going through that era with respect to India. So today you and me have an opportunity, and as you rightly said, the developing period, the country moving from developing to developed, create a lot of wealth creation. So exactly that is the point we all are in.
Yes.
It's up to our hands whether we make use of this opportunity so that we and your next generation can retire wealthy and create a lot of wealth for us.
Absolutely. No, absolutely.
So thank you,
Well
sir,
said.
for spending.
Thank you so much.
Spending so much of time with our viewers and sharing
Thank
your
you.
wisdom. So I hope that all of our viewers will be benefiting from your wisdom. Thank you so much once.
Thank you very much, and I wish all of you a very successful investing journey. And since it's December, Merry Christmas and a very, very happy 2026 to everybody. Thank you.
Thank you.